For decades, the idea of the United States failing to pay its bills has felt almost unthinkable. The US dollar is the world's reserve currency. US government bonds are considered the safest asset on Earth. Entire global financial systems are built on the assumption that America always pays what it owes. On time, every time. But every few years, that assumption is put under intense pressure. Political standoffs in Washington bring the country to the edge of a financial cliff, forcing markets, investors, and ordinary people to ask a question that once seemed impossible. What actually happens if the United States can't pay its debt? This isn't a hypothetical question pulled from a science fiction movie. It's a real risk that economists, bankers, and policymakers quietly prepare for behind the scenes. And while default has been avoided so far, the consequences of even coming close have already sent shockwaves through the global economy. To understand why this matters and what's truly at stake, we need to break down how US debt works, what the debt ceiling really is, and why failing to raise it could trigger consequences far beyond Washington politics. The United States government spends more money than it collects in taxes. That's not unusual. Most large governments do. When spending exceeds revenue, the government borrows money to make up the difference. It does this by selling treasury bonds, notes, and bills to investors. These investors include everyday Americans, pension funds, banks, foreign governments, and central banks around the world. When someone buys a US Treasury bond, they're essentially lending money to the government. In return, the government promises to pay interest and return the original amount after a set period of time. This system has worked reliably for over 2 centuries, which is why US Treasuries are treated as nearly risk-free. The debt ceiling enters the picture as a legal limit set by Congress on how much the Treasury is allowed to borrow. It does not control how much the government spends. That spending is already authorized through budgets, laws, and appropriations passed by Congress itself. The debt ceiling simply determines whether the Treasury is allowed to borrow the money needed to pay for obligations that already exist. That's where the paradox begins. Once Congress approves spending, whether it's military salaries, Social Security checks, interest on existing debt, or federal employee pay, the government is legally required to pay those bills. But if the debt ceiling isn't raised in time, the Treasury loses the ability to borrow the money needed to do so. At that point, the US government faces an impossible situation: bills that must be paid, and no legal authority to raise the money to pay them. If that happens, the Treasury would be forced to delay payments. And the moment the government fails to make a payment, especially an interest payment on its debt, the United States would officially be in default. The consequences of a US default would be immediate and severe. Financial markets operate on trust, and at the center of that trust is the assumption that US Treasuries are safe. If that assumption breaks, even briefly, the ripple effects would be global. Stock markets would likely plunge as investors rush to reduce risk. Bond markets would react violently, with interest rates spiking as investors demand higher returns to compensate for uncertainty. Higher interest rates wouldn't just affect government borrowing. They would filter through the entire economy. Mortgage rates would rise, credit card interest would increase, auto loans would become more expensive, businesses would delay hiring and investment, consumer confidence would collapse. And that's just the beginning. The US dollar's status as the world's reserve currency depends on stability and reliability. If the US government shows that it can be pushed into default through political gridlock, foreign governments and investors may begin reconsidering how much they rely on US assets. Even a small shift away from the dollar could reshape global trade, investment, and power structures. History shows that even the threat of default is enough to cause damage. During a similar standoff in 2011, the United States came dangerously close to missing payments. Although default was ultimately avoided, the impact was still profound. Markets were volatile, consumer confidence fell, and for the first time ever, the country's credit rating was downgraded. That downgrade sent a message to the world. America's political system itself had become a financial risk. Ironically, the debt ceiling was never designed to function this way. It was originally created to simplify borrowing authority, not to serve as a recurring political weapon. Before it existed, Congress had to approve each individual issuance of debt. The ceiling was meant to streamline the process, not to threaten economic collapse every few years. Over time, however, it became exactly that: a pressure point. A way for political parties to extract concessions by holding the full faith and credit of the United States hostage. When the ceiling isn't raised, the Treasury can attempt temporary measures, often called extraordinary measures, to delay default. These include shifting funds between accounts and suspending certain investments. But these tactics only buy time. Once they're exhausted, the clock runs out. At that moment, the Treasury would have to choose which bills to pay and which to delay. There is no clean or painless option. Delaying Social Security payments would harm millions of Americans. Delaying military pay would undermine national security. Delaying interest payments would shatter financial markets. There is no scenario where default is harmless. Because of that, economists across the political spectrum agree that the simplest and safest solution is a bipartisan agreement to raise or suspend the debt ceiling. This has happened dozens of times over the decades under presidents from both parties. Yet in recent years, it has become increasingly contentious. Other solutions have been proposed, some more controversial than others. One option is budget reconciliation, a legislative process that allows certain fiscal measures to pass with a simple majority in the Senate. While technically viable, it's procedurally complex and politically risky. It forces lawmakers to attach a specific number to the debt limit increase, which can be weaponized in campaigns and public debate. Another idea that periodically resurfaces involves the 14th Amendment to the U.S. Constitution, which states that the validity of public debt shall not be questioned. Some argue that this gives the president authority to bypass Congress and continue borrowing. Others warn that doing so would trigger a constitutional crisis and legal challenges that could destabilize markets even further. Then there is the most famous and controversial idea of all, the trillion-dollar platinum coin. Under a little-known law passed in the 1990s, the Treasury has the authority to mint platinum coins in any denomination. In theory, the Treasury could mint a coin worth $1 trillion, deposit it at the Federal Reserve, and use the funds to pay government obligations without borrowing more money. To some economists, this is a clever legal workaround to prevent catastrophic default. To others, it's a dangerous gimmick that undermines confidence in the financial system. The concern isn't whether it's legal, it's whether global investors would trust a government that resorts to such extraordinary measures. Confidence, once shaken, is difficult to restore. Despite all of this, most experts believe an actual default remains unlikely. Not because the system is safe, but because the consequences are so severe that political leaders eventually step back from the edge. Time and again, the debt ceiling has been raised at the last moment. But the bigger issue isn't whether default happens tomorrow. It's what repeated standoffs reveal about the system itself. Every crisis erodes trust a little more. Every near miss teaches markets that political dysfunction can override economic rationality. And every delay increases the long-term cost of borrowing, even if default never occurs. In other words, the damage isn't only in what happens, it's in what almost happens. As the national debt continues to grow and political polarization deepens, the stakes rise with each confrontation. What was once a procedural formality has become a recurring threat to global financial stability. And that leads to a deeper question, one that goes beyond economics and into the future of governance itself. If the world's largest economy can repeatedly bring itself to the brink of self-inflicted crisis, how long can the rest of the world continue to treat its promises as unquestionable? Because at the end of the day, debt isn't just numbers on a balance sheet, it's trust. And once trust begins to crack, even the strongest systems can falter. So the real question isn't just what happens if the US can't pay its debt. It's whether the world will continue believing that it always will.